So, John, let's talk a little bit about then the portfolio and asset mix that you're utilizing for your clients right now. And you did say that it is a little bit uncomfortable slightly to own a lot of equities, but at the same time too, there could be some opportunities and it looks as though the market is just so resilient. So how are you positioned?
Yeah, you're right, Catherine. It is sort of a tough call. We've been in a trading range now for about a year, and we can't seem to break down out of either end from the October lows last year and sort of the 4,200 on the S&P 500 seems a ceiling for now. So, I can start positioning as that is we're a little bit underweight stocks, but not dramatically. And I've sort of been building up, and we're trying to pick our spots. The interesting thing about the market rate is it really has been dominated, particularly so far this year, by a handful of stocks, very narrow breadth, as everybody knows. You keep talking about, the big tech stocks and the way they dominate it. I don't think that continues. Like either everything rolls over, or else you get some broader participation eventually in this market. So we have lightened up on the big tech names in here, and I sort of just added to some of the value stocks that are trading at very low multiples. We added energy, some of the auto names, some of the consumer discretionary names. I know these are things that don't typically act well in a downturn, but I just think they're already reflecting a downturn, so that sort of protects your bias a little to the downside. Haven't really stepped up dramatically on the banks yet, but that's got to be the next spot we're looking at. Certainly, we're in the major banks, in Canada underweight, but still own some, and in the U.S. more the money center banks. Yeah, I think the regionals are a bit more of a stretch at this point, and in like tech,
Hmm.
we'll probably look down the curve a little bit more in tech. It's odd. It's funny. Like people almost treat in this environment that Apple and Microsoft are sort of a safety trade, almost like U.S. Treasuries have been in the past, because they have giant cash flows and their banks onto themselves. They're probably better credits than some governments. And
Hmm.
forget the multiple. We'll pay 25, 30 times for that, but I just don't think that's sustainable. So we're picking around in the portfolio. We've bonds are at a market weight right now, because I think ultimately we get a slowdown in interest rates longer term do start heading back down again. I think we're closer to seeing the peak in interest rates for the cycle if we haven't already seen them. So, that gives you some opportunities out there. So we're not running and hiding. And then having said all of that, I have a little bit more cash in the portfolio than we have had in the past. But I mean, when you look at getting 4 to 5% on 1 year bills or something like that, it's hard to resist while you wait to see what develop in terms of the economic data. The earnings downturn. If we do get another flush to the downside, I think if we started retesting or going back towards those October lows again, and they held, we'd probably at that point be going back to a full weight in stocks and maybe probably an overweight.
Hmm. Let's break that down a little bit in terms of the energy trade. Why is that an area of interest for you right now, especially if people are concerned about the economy? And that's probably what's put some downward pressure on the price of WTI. Obviously, a weaker economy, weaker broader global economy, less demand for oil. Why is that an area you'd step into now?
You know, that's a good point, Catherine. I'll take issue with that a little bit, because I think everybody is focusing on that. Like, first of all, the valuations are just, even at these levels are extremely attractive. You talk to 3 to 4 times operating cash flow, 20% plus free cash flow yields, and the companies have gotten so much more shareholder friendly in the past year or two in terms of buybacks, dividends, getting rid of the debt on the balance sheet rather than growing for the sake of growing. But more importantly, I think people forget that oil is probably the most financially influenced commodity out there. You have more players in the oil market than anywhere else. And I would say the physical market is not reflecting nearly the bearishness that you're getting on sentiment from the financial players. I haven't seen the stats lately on the CBOE or other holdings of oil, but my guess would be that you probably had a larger net short position in oil than you've had for some time. It's very dominating. So people go, financial players go out there, hedge funds or whatever, they get short or they take down their record long positions in oil. And that drives the price down. Much like, remember back in 2008 when oil got driven to $140 a barrel? That wasn't the physical market.
Yeah.
That was all financial players on the long side piling in. I think some of the move to the downside is financial players getting out and to some degree getting short. So I think it's overstated. And
Hmm.
and on top of all of that, I don't need 80, 90, $100 a barrel to make these stocks cheap. They're cheap at 70 to 75, and that's an easily sustainable oil price right now. So add all that together, it's a pretty attractive combination for saying, yeah, let's stay long or add to these positions.
Yeah, absolutely. And I think a lot of people are also thinking that there could be some nice M&A activity within the space as well.